This video is brought to you by Fabian Calvo's new book, The Global Economic Reset: The Day America Loses the World Reserve Currency. If you are interested in purchasing this book, please follow the link in the description of this video. Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is Dr. Jim Willie, editor of the Hat-Trick Letter found on GoldenJackass.com. Jim, thank you so much for joining us today.
Oh, it's a pleasure being on, and the key word that I keep hearing from people and myself is surreal. The times are surreal.
Definitely, and you wrote a new article titled QE Failure and Folly of Paper Mache, and you discussed about how quantitative easing, aka money printing, does not stimulate the economy. Instead, it is destructive to business. So did you want to discuss a little bit about what does this monetary policy actually stimulate, and also what does it harm?
Well, when they call it stimulus, it's really an insult to your intelligence, and if you accept it, then it's a demonstration that you have none. Plainly put, it stimulates the financial sector. Notice that the stock market has gone up while the economy has deteriorated and is in a powerful chronic recession. So why would the stock market go up when profits are not up and the economy and sales figures are down and lots of major corporations are in trouble and Sears is on the verge of bankruptcy and IBM is laying people off? What's going on there? Even Cisco, one of the best of all the computer, or let's say computer technology companies in the United States, even they're pulling back. So why would the stock market go up? Well, because the U.S. government and the Fed are buying stocks. It's not investor funds. This is QE funds. So it's stimulus to the financial sector. It enables more bond purchases when there are almost no legitimate buyers in existence. Notice that the tick reports for U.S. government treasury bond ownership, it shows a steady decline in all the major nations. And you do see occasional months like Japan and China with a lift, and that's kind of queer stuff. It's support for the system. They don't want it to collapse. But also, what is going on in reality with QE? What does it cause? All right, so fine. You get some more bond buyers when the U.S. government cannot finance its debt. Some people call that good. Some people call it stimulus. I call them morons. So what does it cause? It causes a reaction from hedging. It causes a defense mechanism to kick in where intelligent, well-managed organizations, financial entities, and even nations, like with their sovereign wealth funds, start investing in hard assets, because you can't print copper. You can't print gold. You can't print oil. You can't print natural gas. You can't print lumber and cement. So those are the things that intelligent people buy with their spare funds, rather than the crappy, toxic, cancerous treasury bonds. I get so much objection when I tell people, well, the dollar is cancerous, you know. What? The dollar is strong. I said, no, the dollar is cancer. Why do you say that, Jim? Well, we're supporting it with unsterilized monetary inflation of the worst order. Oh, yeah, but it's stimulant. Okay, so you get a circular reaction into the moron camp. The result is that costs are rising. Costs are rising for even services, because the service companies have their own costs, and they're rising. You have increased cost of gasoline, increased cost of everything except the stuff that gets liquidated, which is like all the material and merchandise in the mall traffic. So imported clothing and, I don't know, you get liquidated shoes. I'd like to find some liquidated shoes. I need some new Nikes. But as the cost structure rises, what you get is an eliminated profit margin. And it kills capital. You get the business shutting down. They take the equipment, they put it into a warehouse, they put it into the basement. All right, we're closing down 2 of our 7 business segments. All the equipment from those 2 business segments will go quiet. We will turn them off. So some call it retired capital. I call it killed capital. If you take that capital and then you liquidate it and you sell a nice big widget machine that used to be operating and making money for your company, if you sell it at a 20% loss for what you paid for it, well, that's a liquidation. That's not healthy. That's a killed capital. So it's very depressive to economics while it props that financial market up. QE also is a smokescreen. I mean, if you were to design something, suppose Wall Street said, look, we need something to give us political cover because behind the curtains and behind the walls in the hidden offices, we're doing a lot of bailouts for all the different bonds, the treasury bonds and the mortgage bonds and the other bonds that we own and the exotic leveraged devices that are working off these bonds. We're trying to get rid of them. And we've got about, I don't know, $3 trillion worth of them. Well, we need something to run for maybe 2 or 3 or 4 years so we can get rid of all this crap and have the Fed buy it or have it stuck in Fannie Mae's warehouses under the U.S. government roof. So what can we do? Well, the answer is QE. So it's a smokescreen for a hidden Wall Street bailout to take over their impaired and worthless bonds and other instruments. To me, QE is an absolute guarantee for a systemic breakdown and economic collapse. If it's kept in place, you're going to get more and more ruined capital with feedback loops. The feedback loop goes real simply. Well, we have our cost structure rising, our profits are down, we're going to close 2 of these 7 segments and lay off 68 workers. Those workers spend less in the society, they demand more for the government with state unemployment insurance, and they end up contributing less to the society, to the economy, and then the next round is more and more people. So it's like just take a look at your favorite mall. 3 years ago, you had a few shops that were closed. Now you have maybe a third of them that are closed. All right, the Chinese competition is the other element that makes this different from before. My brother is an economist. I'm sorry, my brother holds a degree in economics. He's now a math teacher. He's a smart guy. He told me, Jim, we got lower interest rates. It always kickstarts the economy. I said, well, not this time. He said, why do you think not this time? You always you think you have all the answers, Jim. And I said, well, this time we had most favored nation status given to China. We had $23 billion of foreign direct investment in 2001, 2, and 3, and China has been reborn as a severe competitor. Did you not notice? And he said, well, yeah, but they're making cheaper stuff. It helps the economy. I said, no, it doesn't. It takes away jobs from the United States, takes away legitimate income, and it makes it unlikely that U.S. banks are going to engage in capital formation for business expansion in the United States. Instead, we'll import more. Okay, so the Chinese competition is what I call the slipped gear in QE as a kickstart. All right, so we're spinning the monetary engines more, and we're not getting any traction on the rear tires for the U.S. economy. In fact, we're getting a historically low and severely declining money velocity. Wow. The U.S. and the West cannot compete against cheap Chinese labor. But notice that Germany has been successful. The only thing that's really whacked Germany is the U.S. sanctions against Russia. It's important to exploit your home's expertise, your home nation's expertise and advantages, and with better and significant efficient processes. That's how you fight China. That's how you fight the competition. Notice that in the 1980s, the entire U.S. outsourcing movement began. This is the climax of that suicidal outsourcing, I don't know what to call it, chapter? It's not a chapter. It's like ingrained in our system. Low-cost solution in 2001. China provided our low-cost solution. My immediate response was, wait a minute, you shut down U.S. industry, you shut down a significant portion of the income. What are you going to rely on? And the answer from the morons and criminals in Wall Street was, we've got a strong financial sector with strong assets, and we can live off that. I said, you mean the housing bubble and the stock bubble? Well, what happens when it breaks? My answer was systemic failure, and that's what you're seeing right now, and proof of it is Lehman, 0% interest policy, and QE forever.
Now, officially, the Federal Reserve ended their quantitative easing quote-unquote stimulus program last Wednesday, but it doesn't seem like you're buying that they're actually ending quantitative easing. So what is next for the actual monetary policy, and what's next for the U.S. economy?
Well, I ask a simple question. Has the Fed, whether it's Greenspan, Bernanke, or this newest clown Yellen, have they told the truth on anything? The answer is no, they don't tell the truth. Greenspan was an expert in obfuscation, which means that he lied through his teeth while taking a second paycheck from the Swiss and the London bankers, helped to wreck the U.S. economy, and kept us sufficiently confused and impressed at the same time, which I think is a very, very loud, ugly indictment of the intelligence level of the United States community. We actually walked away saying things like, I didn't know what Greenspan says, but I'm really impressed. Only idiots say that. Okay, then came Bernanke, who had to defend and make statements that the U.S. economy was recovering in 08 and 09 with the 0% policy. It was not. We've gotten a worse recession every single year. In fact, I'll go so far as to say that the current recession, last year's recession was something on the order of 5%, 4%. And this year, I think it's something on the order of 6 or 7%, the recession. So add up the last 5 years, I think you see roughly a 20 or 25% recession to the U.S. economy in total. Now, I'd like to point out a basic lie that they told recently that exposes how they use the data in deception. There was a report in the end of September, because it was the end of the fiscal year, 2014, and the report actually said that the U.S. government deficit was down to $580 billion based on certain adjustments that made a lot of sense. And I say, why would you make adjustments on an annual figure? Because usually there are adjustments for seasonality and something that cycles in a full year. Well, their adjustments were fraud, accounting fraud. So what I did was something much simpler. I looked at what the debt was at the end of 2014, and I subtracted from that the debt from the end of 2013. Now, this is something that a fourth grader can do, but that's way over the head of these Wall Street and government bankers and economists and accounting wonks. And the answer, if you subtract the debt from 2014 minus 2013, is $1.1 trillion. I made a forecast in 2009, early in the year, that we were going to have annual chronic trillion-dollar deficits because 0% doesn't stimulate, and that we were going to go quickly into QE. All right, that's exactly what we've got, and it's anyone who believes, Elijah, the QE is going to end, I think is an utter moron, has a disconnected brainstem, and an inactive memory. There are no buyers for the U.S. Treasury bonds. There are no buyers for the mortgage bonds. And except for the Wall Street computers, there are almost no buyers for U.S. stocks. So what's going to replace all that? They're saying they're going to withdraw the QE bond support and other financial support. I say you're nothing but a liar. They told us in the summer months of 2013 that they were going to taper down. I called them liars, and by September that was proved correct. They told us that there was Operation Twist, and they were going to do something very clever after QE2. Remember in QE they said this would be temporary, just be a few months. We're going to fix the situation, get some stimulus, jumpstart the economy, kickstart it, and then we had QE2, which I fully forecasted. Then they came with Operation Twist. They didn't tell us what it was. It was the Chinese dumping their long-term treasuries and converting them, that's the twist, into short-term treasury bills that they could wait out for full maturity, like the 1 or 2 years. That's what the Chinese do. So there's no way for the U.S. to finance its trillion-dollar debt. They've got a deficit of $1 trillion. How are they going to finance it? There are no legitimate buyers except a little bit from Japan and a little bit from China because they want to keep Uncle Sam propped so they can keep picking his pockets. They'll let Uncle Sam fall when his assets, namely his muscle tissue, are all gone. It's declared over. Well, then perhaps the Wall Street is a sinister other way of looking at it. Perhaps that means that the hidden Wall Street bailout portion has ended. Maybe it means that Wall Street is done shoveling all their, what was it, 2 trillion, 3 trillion? Who can count it anymore? Maybe Wall Street is done with their hidden backdoor bailouts to get rid of all their toxic, impaired, and worthless bonds. So what comes next, in my opinion, is the hidden debt coverage. It's difficult to stop 80 billion a month over the table and perhaps 200 billion more below the table to cover the derivatives. So I expect the Treasury market, U.S. Treasury market, to go completely underground and to have full and complete dependence upon the interest rate derivatives. It's going to be total. They're going to be run, as they always have, by the J.P. Morgan Chief Investment Office. They call that the CIO. And the U.S. Treasury Department's Exchange Stabilization Fund, which is never in the news, but which is the long arm that controls many, many markets of the entire world. We got a vast propaganda campaign, my guess, very likely. I think it's, like 90% likely. And really what they're trying to do is they're trying to avoid saying, well, the U.S. government debt is not financeable. It's $1 trillion a year, and we have no other way of financing it except with QE and printing money like third world nations do. So we don't want to have an all-out global attack on the dollar because there's already a lot of isolation and avoidance in trade settlements, like with Russians and the Chinese. And we don't want to admit that the Russian sanctions have resulted in an acceleration of the dollar rejection worldwide. If you were to ask 40 Americans, what is the dollar? None of them, well, maybe one or two, would tell you that it's the currency for trade settlement across the world. Most of them think it's the currency for the United States. It's that and a whole lot more, and the whole lot more is going away. The U.S. dollar is rising, and I think that means it's bloated and about to die. What comes next, this is sad to say, is the more complete and recognized U.S. economy collapse. The credit flow is going to be severely hindered because this financial liquidity stimulus flow is going to be inhibited and severely hindered. I think the lightning event comes when the U.S. cannot supply itself. Its inventory supply chain gets interrupted because foreign nations refuse the Treasury bond in payment. Why should they accept a Treasury bond in payment when it's being printed like a third world nation? I mean, it's a bubble asset. Why would anybody, as a supplier of, say, CDs, cars, televisions, bicycles, or cars in a foreign nation, why would they accept Treasury bonds? The U.S. is printing them. They're not investment vehicles. They're evidence of hyper-monetary inflation of the worst order. So the new Scheisse dollar is going to come, and that'll end the QE. We're going to get a lot of foreign nations dumping Treasury bonds, and they're going to amplify the hidden QE to cover them. But there's not going to be any reduction in QE volume. It's going to be an amplification. But what they cannot do is force foreign nations like India, like Korea, just take them for example. They're not going to accept Treasury bonds for legitimate finished products sent to the United States, imported to the United States. They're not going to accept it. They're going to say, no, we want something that's more legitimate. So the U.S. is going to be forced to end QE, admit QE, and come up with a new dollar that gets devaluated seriously and severely. It's going to cause price inflation, supply shortages, and civil disorder. The shortages are going to be in the supermarkets, in the gas stations for fuel, and in the ATMs for cash. I think the U.S. economy is going to follow the path of Venezuela as companies that control the assets inside the United States redirect the output, like farm output, like industry output, They're going to force it into exports in order to raise money and address the trade gap. And that's going to amplify the shortages. The U.S. economy most surely is in the process of collapsing. That's what I think is going on right now and has been for the last couple of years, especially since QE was put on in 2012. I said when it started, it will never stop. Watch, in just a matter of a month or two or three, the Fed will admit, no, we have to put on more. There's a real political angle to this, Elijah, closing point. If they let the financial markets and the bond markets go through some gyrations and palpitations and, what's the word, fibrillations, like a heart attack, then the public and the Congress and all the major centers in the economy are going to say, oh, no, do QE4 by all means. Don't let this collapse happen. So by announcing QE is ending and by letting the jitters and tremors hit the financial markets, they're going to get political permission to do QE4.
Hey everyone, thanks for watching. That's it for part 1. Make sure to click here to continue to part 2.